You are not broke because the world is unfair. You are broke because you do not understand how money behaves over time. If you really understood it, you would panic at how much it is costing you to stay ignorant for one more year. Take a number, $100 a day. That is the price of a casual life. A few meals out, a nicer car payment than you need. Gadgets, subscriptions you forgot you had. $100 a day feels small. People burn that without thinking. Now here is the part almost nobody understands. That lazy $100 a day is the difference between being stressed about every bill in your 50s and having $1.5 million quietly working for you every hour of every day for the rest of your life. I am not talking about a windfall. I am not talking about a genius stock pick. I am talking about one boring habit applied ruthlessly for 25 years. $100 a day, invested at a reasonable rate of return, becomes roughly $1.5 million. Not in theory, in arithmetic. If that number does not bother you yet, it will. Because once you see what you could have had, you will start to understand what you are actually giving up every time you act like money is just for today. Most people live as if every dollar is only about the present moment. What can it buy me now? What comfort can it give me this week? What problem can it fix today so I do not have to think? That is how a child treats money. An adult understands that every dollar is also a little worker that could join an army. If you send that worker out to build more workers, you get compounding. If you send it out to entertain you for 10 minutes, it disappears and comes back with nothing. You are either building an army or throwing away soldiers. Here is the brutal reality. The average person in a rich country will see millions of dollars flow through their hands over a lifetime. Wages, bonuses, tax refunds, gifts, side income. Yet most end up with almost nothing that actually works for them. They die with memories, maybe, but no capital. The system did not steal it from them. Their own habits did. People tell themselves beautiful stories to avoid this truth. I do not earn enough to invest. I will start later, when things calm down. What difference does $100 make anyway? This is how the human brain defends its bad habits. It creates excuses that sound noble and reasonable while they quietly destroy your future. I have watched this pattern for almost a century. Same mistakes, different brands of foolishness. New apps, same old stupidity. People chase clever instead of simple. They want secret formulas and instant results. They ignore the one force in finance that does not care about intelligence, politics, or your feelings. Compound interest. You do not need to be smart to get rich slowly. You only need to avoid being stupid over and over again. But avoiding stupidity requires seeing the stupidity clearly, and that is where most people refuse to look. They cannot stand the idea that the problem is not the system but their own choices, repeated for decades. Let me draw the picture very plainly. You are 30 years old. You decide that starting today, you will treat $100 a day as sacred. That is $3,000 a month. You invest it consistently in a diversified basket of productive assets. Over 25 years, at a compound annual return around 8 to 10%, you are likely to end up somewhere near $1.5 million. People want to argue about the exact numbers. They miss the point. The precise total does not matter. What matters is the order of magnitude. The lazy 100 that evaporates each day is not costing you 100. It is costing you tens of thousands of future dollars in lost compounding every single day. Now let me show you why most people will never do it, even after hearing this. It is not a math problem. It is a psychological problem. Human beings are experts at sacrificing the long term for the short term while telling themselves a noble story about it. You work hard. You go home tired. The world feels uncertain and unfair. You think, I deserve something now. I will worry about the future later. So you swipe the card again and again. That behavior repeated for 10, 20, 30 years, guarantees that your future self will be weaker, not stronger. You are trading a fortress for a hamburger, trading freedom for a fleeting feeling. Then one day you are in your late 50s, still dependent on a paycheck, hoping nothing goes wrong because you never built any real capital. If that sounds harsh, good. Reality is harsh. You can either face it when you still have time to fix it, or when it is too late. People love to fantasize about some big break, a startup, a crypto moonshot, an inheritance. Then they forget the simple discipline that would have made those fantasies irrelevant. They worship complexity and ignore arithmetic. Here is the uncomfortable truth. If you cannot consistently invest $100 a day, you would probably blow $1 million if someone handed it to you. The problem is not the amount. The problem is the operating system in your head. So let us fix the operating system. Let us talk about how this actually works in plain language, so you cannot pretend you did not know. First principle: compounding is not intuitive. Your brain was not built to understand exponential growth. It was built for hunting, gathering, and gossip. That is why people look at $3,000 a month and think, that is just $3,000. They do not automatically see that $3,000 invested monthly for decades grows into 7 figures. Imagine a snowball at the top of a big hill. At first it is small and pathetic. You push it, and it barely picks up more snow. You feel stupid. You think, why am I wasting my time with this? That is the early years of compounding. You invest, and the growth looks trivial. Then, somewhere down the hill, the snowball is no longer a toy. It has its own weight. It rolls faster. Every turn it picks up more snow than the last. That is compounding after time has done its work. The snowball does more than you do. Your money starts earning more income than you contribute. That is the inflection point that changes the rest of your life. But you only get the big snowball if you keep rolling the tiny one when it feels stupid and slow. This is why most people never see compounding work. They stop pushing after the first few years. They get bored. They get tempted. They sell. They restart. They sabotage the only force that could have saved them. Second principle: the rate of return matters less than your behavior. People waste hours arguing whether they can get 7%, 8%, or 10% a year. Meanwhile, they blow 50% of their income on things that leave no trace after 6 months. You want to know the real magic? It is not squeezing a few extra points of return from fancy strategies. It is increasing the gap between what you earn and what you spend, then sending the difference into productive assets and leaving them alone. The discipline to invest $3,000 a month for 25 years is far more powerful than trying to be clever with short-term trades. I made my fortune not by being a genius trader, but by being a rational businessman. We bought stakes in durable, understandable companies that produced real cash. We held them. We let time and compounding do the heavy lifting. The world called it genius. It was patience. Third principle: your lifestyle is either your ally or your executioner. You cannot spend like a king and also invest like a capitalist on a normal income. Something has to give. Most people let their lifestyle expand to swallow every dollar of raise they ever get. Bigger house, fancier car, nicer vacations, more toys. Their cost of living rises in lockstep with their income. So at 30, they tell themselves, when I make more, then I will invest seriously. At 40, they are making more, but their expenses have doubled, so they repeat the same lie. At 50, they are trapped in golden handcuffs, a lifestyle that demands constant high income and no capital base to give them options. One bad year, and the entire thing cracks. If, instead, you make a brutal decision early, my lifestyle will lag my income, not chase it. You can extract that $100 a day and invest it. You force the gap. You live slightly below your means. You let your capital grow above your needs. That is the engine. Here's a picture you should keep in your head. Two people, both 30, both earn the same income. Person A spends 98% of it. Person B spends 75% and invests the rest, roughly that 100 a day. At 55, person A is still working because they must. Person B can choose to work or not. They have an ownership stake in the world's productive assets. They have dividends, interest, rental income, stock growth. That is not luck. That is 25 years of quiet, boring discipline. Fourth principle, you must become the kind of person who can delay gratification without feeling deprived. Most people fail here. They view investing as punishment. They think, if I save and invest, that means I am denying myself life. I have news for you. Constant consumption is not life. It is sedation. It is numbing yourself from the discomfort of thinking about your future. The real pleasure is independence. Waking up one day knowing that if your boss turns into a lunatic, you are fine. If the economy stumbles, you are fine. If you want to help your family, you can. That feeling is worth far more than the 1,000 small indulgences that kept you weak. To get there, you must rewire what you find satisfying. You have to make it emotionally rewarding to see your invested balance grow, not just your collection of things. When you move $100 to investments, you should feel like you just added one more worker to your personal army. That is the mindset of an owner. Fifth principle, you must choose assets that actually produce something. The world is full of speculative games, and people love them because they feel exciting. Flashing numbers, rapid gains, dramatic crashes. It is like a casino with better marketing. Real compounding comes from owning pieces of things that generate cash. Businesses that sell useful products. Real estate that collects rents. Broad market index funds that own hundreds of companies under one simple wrapper. These are not glamorous, but they are powerful. I have always preferred a simple approach. Buy productive assets at sensible prices. Hold them a long time. Avoid high fees. Avoid leverage. Avoid what you do not understand. Let other people chase fads. While they are busy being entertained, you will be busy getting rich slowly. Now let us connect all of this back to that $100 a day, because if it still feels like a vague idea, you will not act. Take someone in their early 30s. They clean up their finances. They cut the nonsense. The extra car they do not need. The oversized apartment. The endless little luxuries that impress people they do not actually like. They free up $3,000 a month. They set up an automatic system every month. That $3,000 leaves their checking account and moves into investments before they can touch it. They choose something boring and broad, like a low-cost fund that owns a slice of hundreds of businesses. They do this without fail, from age 30 to age 55. That is 360 months of contributions at a reasonable growth rate, somewhere in that 8 to 10% range that long-term markets have often delivered. That pile crosses 7 figures, around 1.5 million. Some years it will feel like nothing is happening. Then suddenly, in the later years, the growth per year is larger than what they contribute. The machine has come alive along the way. They are not living in a cave. They are simply not chasing status with every raise. They drive a car that runs. They live in a home that is enough, not an ego monument. They take vacations they can actually afford. They care more about owning assets than impressing strangers. Now compare that to the typical path. Same income, same 25 years. But every time the income goes up, the lifestyle goes up faster. The car payment balloons. The home becomes a display. The credit cards fatten. There is always a reason this year is not the right year to invest seriously. At 55, the second person looks successful from the outside and terrified from the inside. They have stuff, but no fortress. If their income stops, the whole structure falls apart in months. They are a hostage to their own past choices. Both of these futures are built one day at a time. There is no magic moment, just hundreds of ordinary days where you either send that 100 to your future or let it evaporate in the present. Here is a sentence you should remember. Your future wealth is hiding inside your current waste. The money you swear you do not have is already in your life. It is just spending its days entertaining you instead of working for you. If that bothers you, good. It means your brain is waking up. Now let me give you a few very simple, very blunt rules I would follow if I were 30 again and wanted 1.5 million 25 years from now. First, I would calculate the real daily cost of my current lifestyle, not what I think it is, what it actually is. Every recurring payment, every monthly bleed. If I earn, for example, $150,000 a year after taxes, that might be about $100,000. That is roughly $270 per day. If all of that disappears into lifestyle, I am not rich. I am just running a big, leaky machine. Second, I would decide my non-negotiable. At least $100 of that daily flow will go to investments, no matter how I feel. I would treat that as a bill I must pay to my future self. Miss your electric bill, your lights go out. Miss your investment bill, your future goes dark. Same thing. Third, I would make the process automatic, because human willpower is a joke over decades. I would set up automatic transfers. The money leaves my main account before I can notice it. No drama, no decisions, no heroic discipline, just systems. Fourth, I would choose the simplest investment vehicles I understand and stick to them. If I do not understand how something makes money, I do not touch it. I am not trying to win a beauty contest. I am trying to let compounding work. Fifth, I would refuse to panic when the market misbehaves, and it will misbehave, sometimes brutally. There will be years when your statements go down instead of up. You will feel the urge to sell, to wait until things are safe. That is the moment when compounding tests your character. Those who stay the course get the long-term reward. Those who fold donate their future to the patient. People like to say, easier said than done. Of course, it is easier to say than to do. Everything important in life is. That does not change the arithmetic. The numbers do not care about your feelings. There is another trap I want you to see clearly. Starting late. The human mind is very good at delaying. You tell yourself, I will start next year, when the debts are smaller. Then next year arrives with new problems. So you push it again. Every delay destroys compound interest. Start at 30 and go to 55. And $100 a day grows into something like 1.5 million. Start at 40. Do the same thing until 65. Same time span, you get far less. Start at 50. You are mostly making up for lost time. The hill is shorter. The snowball cannot grow as large. Time is the main ingredient you can never replace. People do not like hearing that, so they invent comforting lies. They think, I will make up for lost time later with higher returns. That is how people get scammed, chasing absurd promises. If you try to fix a 20-year delay with fancy strategies, you are not investing, you are gambling out of desperation. The house loves that. So what is the transformation I want for you by the time this is over? I want you to stop seeing $100 as a toy and start seeing it as a seed. I want you to feel physically uncomfortable when you waste money that could have bought your freedom. I want you to look at every day as a choice. Add to your army of capital, or stay a well-dressed servant to your own appetites. You do not need to be a genius. I was never the smartest man in any room. You need to be rational and consistent. You need to avoid the big dumb mistakes. Debt for nonsense, spending for status, panic in downturns, greed in bubbles. If you can just be slightly less stupid than average for 25 years, money will pile up in ways that feel unfair. Remember this: labor is fragile. Capital is durable. Your ability to work for money can vanish in a month. An injury, a layoff, a crisis. But a well-built capital base does not call in sick. It does not care about your boss, your politics, or your mood. It just works. Quietly, every day. Right now, you are probably overexposed to labor and underexposed to capital. You depend almost entirely on your income and almost not at all on your assets. That is why you feel anxiety, even if your income is decent. You are walking a tightrope with no net. The point of that $100 a day is to build the net. There will always be people who hear all of this and say, that is nice in theory, but my situation is different. Everyone thinks they are the exception. They cling to their story like a blanket. They will keep doing what they always do, and they will get what they always get. Then there are a few who will feel the sting of this and decide that their feelings are less important than their future. Those are the ones who will start today, not tomorrow. They will cut something visible so they can build something invisible. At first, nobody will notice. 10 years in, people will start to wonder how they always seemed calm about money. 25 years in, people will call them lucky. Luck favors the prepared, and compounding favors the patient. So, here is the plainest version I can give you. If you want $1.5 million in 25 years, and you are starting from near zero, this is what you must do. You must free up roughly $100 a day, $3,000 a month, and invest it in productive assets with discipline. You must keep doing that through good years and bad. You must protect yourself from your own urges to quit, chase fads, or inflate your lifestyle to match every raise. Most people will never do this because it requires boring repetition and saying no to things that feel good in the moment. They will keep chasing magic bullets instead. They will complain about the rich while refusing to adopt the habits that build real wealth. A minority will accept that the world runs on cause and effect, not wishes. They will rearrange their lives so that capital accumulation becomes non-negotiable. They will treat every day as a chance to either build their future or bury it. They will not be perfect, but they will be persistent. In 25 years, the gap between those two groups will not be subtle. One will be hoping that nothing catastrophic happens. The other will have an asset base throwing off income, cushioning every blow, and buying back time. Same country, same economy, same stock market, same years. Different choices, repeated daily. You can keep thinking of $100 as pocket money, or you can start treating it as a brick in the fortress that will protect you for the rest of your life. One choice leads to a lifetime of dependence dressed up as comfort. The other leads, slowly but relentlessly, to $1.5 million of capital and the freedom that capital buys. No one is coming to do this for you. Not the government, not your employer, not your family. It is arithmetic and discipline, or it is drift and regret. Decide which side of that equation you want to be on, and then prove it tomorrow when you wake up and that $100 is sitting there waiting to be wasted or invested.